New York's housing market is pulling off a paradox: more choices on the ground and record-setting deals in the sky. Start with the citywide frame. The last calendar year closed with New York City's median sale price at $780,000, up 4% year-over-year in 2025. Transactions rose too. 30 1941 homes changed hands across condos, co-ops, and single-family properties, 6% more than the year before. Manhattan alone ended 2025 with a median sale price of $1.15 million and 12,851 sales, the largest jump in transactions among the boroughs at 11%. That was last year's finish line. Then January arrived and something unexpected happened. A single building on Madison Avenue began to dominate Manhattan's luxury contracts. At 1,122 Madison Avenue, between East 83rd and East 84th Streets, 9 units went into contract over 2 weeks after floor plans were released on January 15th. Manhattan's luxury residential deals in January totaled $885,663,000. Roughly 10% of that came from this one address on the Upper East Side. Prices at the building were raised 3 times within weeks of launch, and the neighborhood responded. 14 sales closed above $4 million on the Upper East Side in a single week, with the 5 priciest contracts all inside 1,122 Madison. Those 5 included a 5-bedroom at 4,346 square feet, asking $22,950,000, a 5-bedroom at 3,178 square feet, asking $14,325,000, a 4-bedroom at 3,178 square feet at $12,925,000, a 3-bedroom at 2,765 square feet at $12,225,000, and another 4-bedroom at 3,178 square feet at $11,825,000. One building, one block from Central Park. 26 residences across 22 floors. It's a snapshot of a luxury tier that keeps finding oxygen even as the broader market searches for balance. What unlocked the shift beneath that top tier is simpler. Mortgage rates calmed. By late January, the average 30-year fixed hovered near its lowest level in almost 3 years, 6.17% as of January 26th. For months, rates have traded in a narrow band between 6.1% and 6.3%. Depending on the lender and day, the 30-year fixed has been quoted around 6.10% to 6.375%, while 15-year fixed loans have sat lower, roughly in a range from 5.25% to 5.818%. Signals suggest that stability brought buyers back into the hunt late last year. Sellers noticed. More homes entered contract in December than the season typically invites, and new listings followed. That's the engine behind a different surprise. This winter, inventory rose while sales picked up. Citywide, the number of homes for sale is up by more than 9% year over year. It's not evenly distributed. Certain pockets are surging. In Brighton Beach, available listings jumped nearly 49% in a single year. In Queens, Flushing posted a 48% leap, with Rego Park in Long Island City seeing sharp climbs as well. Brooklyn's spike isn't clustered. It stretches from Bushwick and Crown Heights to Midwood, East Flatbush, and Sheepshead Bay. Even Manhattan joined the list in a place you might not expect. The Financial District recorded one of the strongest gains in new listings anywhere in the city. The story here isn't that New York suddenly has housing to spare. The long-term shortage remains, especially in Manhattan, where new construction has lagged population growth for more than a decade. The story is that, in the short term, the spring market feels different. More choices, fewer panic bids, a little room to negotiate. Zoom back into the map of price and activity. At the top, Hudson Yards remained the city's most expensive neighborhood for the 7th consecutive year, with a 2025 median sale price of $5.58 million. But that top-line number hides a twist. The median there actually fell 22% year over year. Sales moved in the opposite direction. Transactions in Hudson Yards jumped 83%, a rise that amounted to 20 additional sales, concentrated at 35 Hudson Yards and 15 Hudson Yards. That's the split screen in miniature. Prices adjusting, volume accelerating. Right behind, SoHo reclaimed the number 2 spot with a median of $3.73 million after a 20% annual jump, aided by higher prices for co-ops that closed last year. Sales in SoHo rose 24%, totaling 130 transactions. TriBeCa ranked third, its median climbing 12% to $3.7 million, with 329 sales after a 19% increase that included 62 more condo closings than the prior year. NoHo landed fourth with a median of $3.31 million, up 12%, and 38 sales, 27% more, yet just 8 additional deals in absolute terms. Central Park South rounded out the top 5, with a median of $2.93 million across 104 closings, up 12% in price and 8% in transactions. In 6th place, Nolita posted a $2.85 million median, a 19% gain. Hudson Square took 7th at $2.65 million, rising 26% with 79 total sales, 60 of them condos. Carnegie Hill held 8th with a median of $1.94 million, down 3%, but with robust activity, 620 transactions, 468 of them co-ops, plus 15 single-family homes. Nomad ranked 9th at $1.89 million, one of the few top 10 areas with a year-over-year decline in price, down 3%, and a 25% drop in sales to 160. Brooklyn's Cobble Hill rounded out the top 10 at $1.85 million, essentially flat through the year. The city's top 50 most expensive neighborhoods weren't just about medians. The minimum median to make that list was $980,000. Manhattan placed 25 neighborhoods in that top tier. Brooklyn accounted for 21. Queens placed 6. Across those 50, two-thirds recorded price gains in 2025, some as high as 39% year over year. The Columbia Street Waterfront District led that pack, with a median jumping 39% to $1.53 million, propelled by a heavier share of condo sales, which rose to 88% of transactions from 76% the year before. Not all movement pointed up. Red Hook's median fell 34% to $1.31 million, a plunge influenced by the smaller average size of homes that sold there, down to 1,612 square feet from 2015, a year earlier. Carroll Gardens also saw a sharp drop, down 23% to $1.51 million, a change shaped by fewer single-family homes in the mix. In contrast, Manhattan Beach and Mill Basin recorded some of the next sharpest increases, up 35% and 33% respectively, one driven by a larger share of single-family sales, the other by larger average square footage for homes that moved in 2025. Sales told their own story. In Boerum Hill, transactions surged 143% year over year, a spike driven by closings at 323 Bergen Street. The neighborhood's median rose 19% to $1.79 million. Greenwood Heights posted 39% more sales, including more condos and more single-family homes than in 2024. Williamsburg saw transactions jump 27% to 658 closings, with around 10% of those at One Domino Square condominiums. In Queens, Malba ranked 16th overall with a median of $1.49 million on just 20 sales, all single-family homes. Fresh Meadows reached a $1.1 million median after a 12% gain. Bell Harbor landed at 43rd with a $1 million median, up 8%, on a small base of 21 houses and 5 co-ops. Hunters Point, by contrast, dipped. It ranked 45th with a $997,000 median, down 15% year over year. Sales there fell 24% to 239. Take these together with the January luxury surge on the Upper East Side, and you get the outline of a split market. The upper tier remains loud. The middle is moving in pockets, pulled along by steadier borrowing costs and more choice. Citywide inventory, up more than 9% year over year, has created something rare in New York, rising supply while sales also pick up. Brighton Beach's nearly 49% jump in listings changes the tenor of a neighborhood that usually runs on scarcity. Flushing's 48% rise delivers a similar shock in Queens. Rego Park and Long Island City are climbing too. In Brooklyn, the inventory swell is democratic, Bushwick, Crown Heights, Midwood, East Flatbush, and Sheepshead Bay. And in Manhattan, a fresh burst of listings in the financial district adds to the chorus. Step back to the mortgage channel. The temperature there matters to every line on this ledger. As of January 26, the 30-year fixed sat at 6.17%, near its lowest reading in nearly 3 years. The band between 6.1 and 6.3% has held for months. Expectations point to that range continuing through 2026, with brief dips into the 5% zone and an average around 6.3% for the year. That steadiness has already nudged behavior. Mortgage purchase applications have climbed to their highest level in 3 years. More buyers are testing the waters. More sellers are stepping forward, having watched contracts increase in December when the market usually rests. What does that mean on the ground? It means fewer bidding wars in the neighborhoods where inventory is surging. It means sellers in Brighton Beach or Flushing will need to price with more precision to compete against a larger slate of listings. It also means not every part of the city is suddenly a buyer's paradise. The long-term shortage in Manhattan hasn't healed. Years of construction trailing population growth leave a tight funnel, even with a near-term influx of listings in the financial district. And the numbers inside the top 50 most expensive neighborhoods show how sensitive medians are to what sells. Smaller unit sizes in Red Hook. More single-family homes in Manhattan Beach. More condo-heavy closings in the Columbia Street waterfront district. Price lines move because the mix moves. On the Upper East Side, that mix in January tilted toward new construction luxury. At 1,122 Madison unit sizes that crest above 3,000 square feet command 8-figure prices. The fact that sales there captured roughly 10% of Manhattan's monthly luxury contracts out of $885,663,000 total tells you that a single project can still swing the tone. 14 deals above $4 million in 1 week, all within the same neighborhood, say the appetite at the top has not gone away. It may be migrating to new buildings that finally open their doors, but it's present, even as some of the highest-profile neighborhoods record softer medians. Hudson Yards at a $5.58 million median, down 22% year-over-year, with sales up 83%, is a vivid example. More closings at slightly lower price points are a recipe for a falling median and a busier pipeline. SoHo's $3.73 million median, after a 20% rise, paired with a 24% jump in transactions, shows the inverse: rising prices and rising activity when the product mix shifts upward. Broadened to borough-level texture, Manhattan's $1.15 million median and 12,851 sales in 2025 set the stage. But the borough's micro-markets are moving in different directions. NoHo's price up 12%. Nomad's median down 3%, with a 25% sales drop to 160. Carnegie Hill's median off 3%, but with 620 closings, driven by 468 co-ops and a handful of single-family homes. Central Park South notches 12% gains in both price and sales, with 104 transactions. Hudson Square's 26% jump to a $2.65 million median rides on 79 sales, 60 of them condos. These aren't random swings. They are the math of what sold. In Brooklyn, the distribution is equally specific. Cobble Hill steadied at a $1.85 million median. Boerum Hill's $1.79 million median and 143% surge in sales owes to a single address, 323 Bergen Street, releasing enough units to alter the year's count. The Columbia Street waterfront district's 39% leap to $1.53 million hinged on an easier sentence to explain: more condos and bigger ones. Red Hook's 34% drop to $1.31 million traces to a smaller average home, 1,612 square feet versus 2,015 square feet a year earlier. Carroll Gardens fell 23% to $1.51 million because fewer single-family homes traded. Williamsburg's 658 transactions, up 27%, came with around 10% of closings at One Domino Square condominiums. Greenwood Heights posted 39% more sales year over year. Queens is narrower at the top, but no less telling. Malba, with 20 sales, all single-family homes, landed 16th overall at a $1.49 million median. Fresh Meadows reached $1.1 million after a 12% climb. Bell Harbor's median hit $1 million after an 8% bump on 21 houses and 5 co-ops. Hunters Point's median slid to $997,000, down 15%, as sales fell to $239, a 24% drop. And outside gross medians, the listing flow is shifting fast. Flushing's 48% jump in active listings gives one of the city's busiest markets a different feel. Rego Park and Long Island City add to that surge. In a few neighborhoods, buyers now have time to walk the block twice before deciding. Underneath, the national environment matters to a local decision. The median U.S. sale price sits at $429,000, edging up 0.6% from a year ago and up 30% over 5 years. Inventory across the country has built to nearly 1.7 million homes for sale, one of the highest December levels since the pandemic, creating what many call the strongest buyer's market in years. Some of that excess sits in the South, with disaster-prone areas of Florida showing the biggest imbalances between sellers and buyers. But the effect bleeds into New York psychology. When rates drop and choice expands elsewhere, sellers in the 5 boroughs take cues. They test the market. They add listings. They watch the weekly average on the 30-year fixed. 6.17% on January 26th, a consensus that 6.3% is a reasonable average for 2026. More confidence appears. More buyers arrange tours. None of this erases the constraints. Price is still high, even in a steadier rate regime. In New York City, the 2025 median at $780,000 is 4% higher than the prior year. In Manhattan, $1.15 million is not a small hurdle. That's why the surge in inventory is so consequential, especially in the outer borough neighborhoods where the climb is steepest. Brighton Beach's nearly 49% jump in listings could soften the frantic pace that defined the last few years. Buyers there, and in Flushing's 48% swell, may find sellers more open to concessions. In Manhattan's financial district, a stronger pipeline of new listings puts pressure on asking prices that drifted upward when supply was tighter. To be clear, this is a shift at the margins. New construction still trails population growth in Manhattan over a long arc. But in the near term, more signs hang in more windows across more corners of the city. On the high end, the narrative is different. The Upper East Side's cluster of contracts above $4 million shows a durable demand for new product. A building a block from Central Park, with 26 condos across 22 stories, can raise prices 3 times in its first weeks and still account for roughly 10% of Manhattan's monthly luxury total. That's power. It's also concentration. The 5 largest Upper East Side contracts between January 26th and February 1st were all in that one building, at ask prices of $22,950,000, $14,325,000, $12,925,000, $12,225,000, and $11,825,000. Spread that across floor plans of 4,346 square feet, 3,178 square feet, 3,178 square feet, and 3,178 square feet. This segment doesn't move the median for the whole city. It moves sentiment. It sets comps in a band where even small changes in inventory ripple through. So, who benefits as we move into spring? If you're hunting in neighborhoods where listings jumped, Brighton Beach at nearly 49%, Flushing at 48%, Rego Park, Long Island City, Bushwick, Crown Heights, you gain leverage. You can negotiate inspection credits, ask for closing cost help, or push on price without immediately losing the deal. If you're selling in those same pockets, speed and precision matter. List too high in a street with 24 alternatives, and you risk being the stale one. If you're buying in Manhattan's trophy corridors, SoHo at a $3.73 million median, TriBeCa at $3.7 million, Central Park South at $2.93 million, the shift is less about leverage and more about timing. Rates in the 6s, with occasional dips into the 5s, can create brief windows when the competition thins. Contracts in December ran above seasonal norms once rates steadied, A similar burst could arrive after another dip. If you're watching for structural signals rather than moments, look at how the product mix is shifting. In 2025, two-thirds of the top 50 most expensive neighborhoods posted gains of up to 39% year-over-year. But the neighborhoods with the sharpest moves, Columbia Street Waterfront District up 39% to $1.53 million, Red Hook down 34% to $1.31 million, did so because the mix changed. More condos of larger average size in one, smaller homes in the other. Manhattan Beach up 35% because more single-family homes sold. Mill Basin up 33% because the average square footage increased. Carroll Gardens down 23% because fewer single-family homes traded. Hunters Point down 15% because the condos that sold were on average smaller than in 2024, with transactions falling 24% to 239. Pricing isn't a pure demand read. It's a mirror of what sells. Rising sales are their own signal. Borum Hill's 143% jump in closings points to new supply hitting at 323 Bergen Street. Greenwood Heights up 39%. Williamsburg up 27% to 658 closings, with around 10% at One Domino Square condominiums. In Hudson Yards, sales climbed 83%, even as the $5.58 million median fell 22%, and all sales took place at 35 Hudson Yards and 15 Hudson Yards. That's the market finding equilibrium at new price points for new delivery. The national economic layer still matters. If broader inflation creeps up, mortgage rates could drift higher, which would raise monthly payments at every price bracket. If inflation eases or policy pulls rates lower, the market could see more buyers re-enter, particularly in the mid-price segments, tightening negotiation room in inventory-rich neighborhoods. For now, rates anchored around 6.1 to 6.3% make 2026 look navigable. If the year averages 6.3% and sees occasional dips into the fives, as expectations suggest, that could fuel periodic flurries of contracts similar to December's above-seasonal pace. For anyone working the details, agents, lenders, developers, the ripples are concrete. Lenders are quoting 30-year fixed rates between 6.1% and 6.375%, with 15-year loans often in the 5.25 to 5.818% lane. Builders see what a single project can do. In Manhattan, one address at 1,120, 2 Madison commands headline mindshare. In Brooklyn, one address at 323 Bergen Street moves a neighborhood's annual sales line by triple digits. In Queens, a project like One Domino Square in neighboring Brooklyn can pull attention across borough lines, contributing roughly 10% of Williamsburg's annual transactions. This is a market where individual towers and individual releases matter. If you're navigating it as a buyer, understand where your leverage lives. In Brighton Beach, a nearly 49% surge in active listings creates options. In Flushing, 48% more inventory does the same. In Rego Park and Long Island City, climbing stock means less urgency. In the financial district, more new listings might reopen conversations that stalled when supply was thin. If you're considering SoHo or TriBeCa, recognize that higher medians, $3.73 million and $3.7 million respectively, came with more sales, not fewer. That tells you buyers are paying up for the right product. If you're shopping Carnegie Hill, your odds of finding a co-op are high. 468 of 620 transactions last year were co-ops, and the median at $1.94 million drifted down 3%. If you're leaning toward Nomad, both prices and sales pulled back in 2025, down 3% in the median and down 25% in closings to 160, signaling a possible opening. If Hudson Yards is on your list, brace for high medians at $5.58 million even after a 22% drop, but expect more availability as sales rose 83% and concentrated in 2 addresses. The citywide canvas is complex but legible. A $780,000 median across New York City in 2025, up 4%. 1,941 transactions, up 6%. Manhattan at $1.15 million with 12,851 sales, up 11%. A top 50 list where two-thirds of neighborhoods registered price growth up to 39%. A minimum median of $980,000 to crack that top tier. Manhattan with 25 of those neighborhoods. Brooklyn with 21. Queens with 6. Inventory up more than 9% year over year. Neighborhoods like Brighton Beach and Flushing up nearly 49% and 48% in listings, reshaping the spring feel. A financial district resurgence in supply. And a single building at 1,122 Madison, sucking up roughly 10% of Manhattan's January luxury contracts out of $885,663,000 total, with 5 headline deals from $11,825,000 to $22,950,000. What's next? Base case through mid-year, rates hold in the 6.1 to 6.3% band, with the weekly average around 6.17 moving sideways. Inventory remains elevated in targeted pockets: Brighton Beach, Flushing, Rego Park, Long Island City, Bushwick, Crown Heights, Midwood, East Flatbush, Sheepshead Bay, giving buyers added leverage where listings climbed the most. Manhattan's long-term shortage keeps top-tier neighborhoods tight, even as the financial district's new supply releases some steam. Price growth moderates in aggregate but stays volatile at the neighborhood level, depending on what sells. Luxury continues to transact where fresh product opens, with focal points like 1,122 Madison shaping monthly totals. Watch 2 things closely. First, the rate pulse. If the 30-year fixed dips into the 5s, even briefly, expect a flash of contracts like December's above-season norm, which could drain the new inventory in a handful of zip codes, and harden seller resolve in the next round. If rates drift above 6.3%, momentum could slow in mid-tier neighborhoods and widen negotiation windows. Second, the inventory spikes themselves. If Brighton Beach's nearly 49% surge and Flushing's 48% jump persist into summer, expect a measured softening in those price bands. If they fade, the window for buyers narrows and pressure returns. A third signal bears watching in the data we already have: product mix. When the median jumps 39% in the Columbia Street waterfront district because larger condos anchor sales, or falls 34% in Red Hook because average home size shrinks, it underscores how quickly medians can move when the composition shifts. Track the mix, not just the price. In a city defined by edges, this is the story of a market splitting but not breaking. A $780,000 median and 31,941 sales in 2025 show underlying demand. An Upper East Side tower that captures 10% of January's luxury dollar volume proves appetite at the top. Inventory up more than 9% year over year, nearly 49% in Brighton Beach and 48% in Flushing, gives the middle air to breathe. Rates around 6.1 to 6.3%, with 6.17% as of January 26th. Set the cadence. The next few months will decide who uses that tempo best. If this kind of data-first tour helps you navigate New York's market, consider staying with us for the next move.